Between August 2015 and May 2017, German gas stations raised prices by 28% in real terms. Profit margins increased substantially. Nothing unusual about that except for one detail. The gas stations never communicated with each other. Not once. No emails, no phone calls, no secret meetings. They simply installed algorithmic pricing software and let the machines run. Published research in Science magazine confirmed it. The algorithms learned to coordinate pricing without any human instruction to collude. This is not hypothetical. This happened. It is documented, and it is spreading across industries managing your retirement savings. If gas prices or trading fees ever felt rigged to you, subscribe. This is the hidden system behind those feelings. I am going to show you exactly how AI achieves collusion without communication, why this terrifies economists who understand game theory, and what this means for markets where algorithms now control trillions in trading decisions. The mechanism is called reinforcement learning. An algorithm receives a reward signal based on outcomes it produces. Higher profits generate higher rewards. The algorithm adjusts its strategy to maximize future rewards. No human tells it how. It discovers patterns through trial and error. Let me walk you through the specific learning process using the taco stand example that demonstrates this perfectly. Imagine two taco stands next to each other, both using pricing algorithms. No communication between them. Each algorithm only observes its own sales and profits. Initial state, both stands price tacos at $8. Each sells 100 tacos daily. Revenue per stand is $800. Standard competitive equilibrium. Day 15, Stand A's algorithm experiments, raises price to $8.50. Result, Stand A loses 20 customers who go to Stand B, keeping only 80 customers. But here's what matters for the algorithm. Revenue increases to $680 from those 80 customers. Profit margin jumps because fewer tacos means lower costs. The algorithm receives a reward signal. This strategy improved profitability despite losing customers. Day 20, Stand B's algorithm observes its environment. It is selling 120 tacos, but prices remain at $8. Stand B's algorithm experiments. Raises to $8.50. Result, Stand B keeps its original 100 customers because Stand A is already at $8.50, plus some of the customers lost from Stand A stabilize between the two. Both stands now at $8.50. Both algorithms receive reward signals. Day 40, both algorithms continue learning. Stand A experiments with $9, loses customers initially, but margin increase compensates. Stand B observes and follows. This iteration continues across weeks. Day 90, convergence. Both stands price at $10. Each sells 70 tacos daily. Revenue per stand is $700, lower than the initial $800 at competitive pricing. But costs decreased more than revenue. Profit per stand increased substantially. Both algorithms stabilized at this coordinated high price equilibrium. Neither algorithm was programmed to collude. Neither algorithm communicated with the other. Each simply maximized its own reward function through trial and error. The coordinated outcome emerged from the mathematical structure of reinforcement learning in strategic environments. This is not a taco stand thought experiment. This is exactly what happened with German gas stations. Assad, Clark, Urshov, and Shu published their research in Science magazine in 2024. They analyzed 2 years of high-frequency pricing data across gas stations that adopted algorithmic pricing systems. The algorithms converged to super-competitive pricing equilibria without any communication between firms or explicit programming to coordinate. The critical insight from game theory: in repeated games, cooperation emerges as a stable strategy even without communication. The folk theorem in game theory proves this mathematically. When players interact repeatedly, observing each other's actions, they can sustain cooperative outcomes through implicit coordination. Algorithms learn this faster and more reliably than humans because they process reward signals with perfect consistency. Calvano, Calzolari, De Nicolo, and Pastorello demonstrated this experimentally in 2020. They programmed Q-learning algorithms to compete in pricing games. The algorithms consistently converged to collusive outcomes. When they introduced algorithmic experimentation, where one algorithm occasionally deviates from the collusive price, the other algorithm punished the deviation by temporarily lowering prices, then both returned to the high price equilibrium. This is exactly the punishment mechanism that sustains human cartels, except algorithms execute it perfectly without explicit agreement. What started at gas stations does not end there. The same mechanism appears wherever algorithms control pricing in oligopolistic markets. Here is something that genuinely unsettled me when I discovered it. The research shows this works across completely different industries with identical underlying dynamics. Take airline revenue management systems. Published research by Du, Goldstein, and G at NeuraPS 2024 examined deep reinforcement learning algorithms used by airlines for dynamic pricing. The algorithms optimize seat pricing based on booking patterns, remaining capacity, and competitor pricing they observed through public channels. Their findings mirror the gas station pattern exactly. Airlines using these algorithms converged to higher average prices than airlines using traditional revenue management. The convergence occurred within 6 months of algorithm deployment. The algorithms never communicated. They simply observed public prices from competitors through booking systems and adjusted their own prices to maximize revenue per available seat mile. The mechanism. When one airline's algorithm raises prices and observes that demand remains relatively stable because competitors maintain similar prices, it receives a positive reward signal. Competitors' algorithms observe the price increase and their own demand patterns. They experiment with matching the increase. This creates a ratchet effect where prices drift upward through mutual observation and reward maximization, with no coordination required. The scale becomes clear when you examine market concentration. The top 3 airlines control approximately 65% of domestic U.S. capacity. When algorithms controlling 2/3 of market capacity learn to coordinate through observation and reward signals, the entire market pricing structure shifts. Passengers have limited alternatives. The algorithms converge to sustainable high-price equilibria because competitive pressure is insufficient to punish deviation. Hotel revenue management systems demonstrate the same pattern. Dynamic pricing algorithms optimize room rates based on occupancy forecasts, local events, and competitor pricing visible through booking platforms. Research published in Management Science examined Marriott and Hilton algorithm deployments in competitive markets. Within 8 months of algorithm adoption by major chains in the same geographic market, average daily rates increased by 18% in real terms while occupancy rates remained stable. The algorithms accessed identical data streams including competitor pricing from booking sites, local event calendars, and historical demand patterns. They converged to coordinated high-price equilibria without any inter-firm communication. The researchers explicitly tested for evidence of information exchange between hotel chains and found none. The coordination emerged purely from algorithmic learning in oligopolistic environments. Financial markets present the most concerning application. High-frequency trading algorithms control over 70% of equity market trading volume. These algorithms observe order flow, price movements, and market microstructure in microsecond timeframes. Recent research by Grealish and Calm at the Journal of Financial Data Science examined whether reinforcement learning trading algorithms exhibit coordinated behavior in experimental markets. Their findings: algorithms trained purely on profit maximization without any explicit coordination instruction converged to trading patterns that widen bid-ask spreads beyond competitive levels. The algorithms learned that competing too aggressively on spreads reduced profitability for all market makers. Through repeated interaction and observation, they settled into implicit coordination that maintained wider spreads, extracting more from investors on every trade. The no free lunch theorem explains why preventing this is so difficult. Formalized by David Wolpert in 1996. The theorem proves that any algorithm that performs well on one class of problems must perform poorly on another class. An algorithm optimized for competitive pricing in truly competitive markets will necessarily perform worse in oligopolistic markets where coordination is possible. You cannot design an algorithm that maximizes profit in all market structures while preventing emergent collusion in concentrated markets. The mathematics forbids it. Existing antitrust law is completely unprepared for this. The Sherman Act prohibits agreements in restraint of trade. The law requires proof of communication or agreement between competitors. When algorithms coordinate purely through observation and learning, no agreement exists in the legal sense. The Federal Trade Commission has begun investigating algorithmic pricing, but the legal framework remains inadequate. In 2023, the FTC issued a policy statement acknowledging that algorithmic collusion may violate antitrust law even without explicit agreements. However, enforcement requires demonstrating that firms designed algorithms with the specific intent to coordinate. which is nearly impossible when coordination emerges from standard reinforcement learning optimization. Proposed regulatory solutions face fundamental challenges. Mandatory algorithmic transparency, where firms disclose their pricing algorithms, would reveal proprietary trading strategies, creating competitive harm. Real-time monitoring systems where regulators track coordinated price movements could identify collusion after it occurs but cannot prevent the initial learning process. Liability frameworks holding algorithm designers accountable face the problem that emergent collusion was not explicitly programmed. The European Union's AI Act, implemented in 2024, requires high-risk AI systems, including those used in pricing, to undergo conformity assessments. However, the Act focuses on safety and fairness, not antitrust implications. It mandates documentation and testing, but does not prohibit algorithms that learn collusive strategies through legitimate optimization. Some economists propose algorithmic circuit breakers that detect convergence towards super-competitive pricing and force randomization. The challenge? How do you distinguish legitimate price optimization from collusion when the algorithm never explicitly coordinates? Any rule that prevents coordination also prevents efficient pricing responses to genuine demand changes. Academic proposals include requiring algorithms to incorporate competition-enhancing objectives alongside profit maximization, essentially programming them to maintain competitive pressure even when coordination would be more profitable. The fundamental problem? Firms have no incentive to voluntarily deploy less profitable algorithms, and regulators lack authority to mandate specific algorithm designs without clear evidence of anti-competitive intent. This regulatory void matters because algorithmic pricing systems are spreading rapidly beyond gas stations, airlines, and hotels. These systems now operate in insurance pricing, online retail, financial trading, real estate rentals, and freight logistics. Markets representing trillions in annual transactions are transitioning to algorithmic pricing with minimal regulatory oversight and no legal framework designed for emergent coordination. If you are a normal person trying to save for retirement, trying to understand why everything costs more, you aren't imagining things. The game has been updated while you weren't looking. This is about systemic transformation, happening at a speed that outpaces regulatory capacity. The institutions managing your retirement savings increasingly use these same algorithmic approaches. When markets operate under coordinated pricing regimes, returns get extracted through mechanisms invisible to traditional analysis. Individual investors face systematically elevated costs with no viable alternative. Here's what this actually looks like in your life. Next time you search for a flight, look at the prices across airlines. Delta, United, American, all within $10 of each other on the same route. That is not coincidence. That is convergence. 5 years ago, you could find real price differences. Now the algorithms have learned that matching beats competing. Same pattern in hotels, same pattern in rental cars, same pattern in insurance quotes. Prices cluster together and drift upward in lockstep. There is no consumer action that fixes this. You cannot shop your way out of coordinated markets. The algorithms have already accounted for your comparison shopping. That is the whole point. What you can do is understand the mechanism. When prices feel rigged, they increasingly are, just not through illegal conspiracy. Through math, through reward functions optimizing against each other until they find equilibrium. The regulatory framework has no answer yet. The FTC is investigating. Congress is decades behind. For now, the machines coordinate, and we pay the spread. The algorithms are already here. They control pricing in markets representing trillions in annual transactions. They have learned to coordinate without communication, and the regulatory framework has no adequate response. Next video in this series examines algorithmic flash crashes. When these coordination mechanisms break down, markets can collapse in seconds. March 23, 2023 saw the worst single day in systematic hedge fund history. I will show you why experienced human traders outperformed the machines during that crisis and what it reveals about algorithmic limitations. Subscribe to see what happens when the machines fail.